Welcome to the Deep Dive. We're the place where we sift through complex sources to bring you the essential insights, tailored just for you, our listener. Today, we're tackling something really central. It impacts, well, everyone's finances, and maybe even the stability of the whole global economy. We're talking about the U.S. dollar and its potentially shaky position. Our sources are suggesting that if people lose faith in the dollar, which, let's face it, underpins the entire international money system, the whole thing could be at risk of, well, collapse.
Yeah, and what's striking right away is how these sources challenge the usual way of thinking. They're really critical of standard economic tools, things like equilibrium models, value at risk metrics. They basically say these tools are, quote, meaningless now because we're in a perturbed equilibrium.
Okay, perturbed equilibrium. What does that actually mean in plain English?
It means the old assumptions, the idea that economies naturally settle into a stable state. They just don't apply anymore, according to these sources. They argue the world economy isn't finding a new normal. It's more like we're sailing without a compass or chart, and turbulence is now the norm.
That sounds
Yeah.
unsettling. And it gets worse, doesn't it? The sources seem to suggest that our trust in central banks might actually be part of the problem.
Exactly. They float this really provocative idea that misplaced confidence in central banks is, quote, ruining our markets. So we're going to explore how their policies, maybe intended to help, could actually be paving the way for, well, more financial trouble down the road.
Right. So let's start there. These hidden costs, these distorted markets. Where do we begin?
Well, let's look at the Federal Reserve, the Fed. Their stated aim is inflation. They want to get it to at least 2.5%, maybe higher. And the way they plan to do that, printing money, the goal is kind of explicit. Dilute the real value of U.S. debt, make it worth less, and also avoid deflation.
Okay, printing money creates inflation. That sounds simple enough. But what's the catch? Our sources see a major risk here, don't they?
They do, a big one. The risk, they argue, comes down to history and psychology. Once you hit that inflation target and people expect prices to keep rising, you could trigger a feedback loop.
Hmm.
Higher inflation breeds expectations of higher inflation, which then causes even higher inflation. It could become uncontrollable.
Like a spiral.
Exactly. They're saying the Fed might not be able to stop it once it starts. They point to the late 1970s as a cautionary tale that maybe we're not paying enough attention to.
Wow. Okay. And connected to this inflation push is the whole wealth effect idea, right? The theory that if stock prices and house prices go up, people feel richer, so they spend more.
Right, that's the theory. But our sources are pretty skeptical.
Oh.
They call it mostly a mirage. They argue it doesn't really boost the real economy, jobs and production. It just merely enriches brokers and bankers. Think about it, they say. We've had America's third stock bubble, the second housing bubble, all in just 15 years. And the sources warn, when these bubbles pop again, we could face a worse panic than occurred in 2008.
So the policy isn't really helping Main Street, it's just inflating assets for Wall Street. Is that the idea?
That's the core argument. It creates an illusion of wealth, benefits a select few, but doesn't strengthen the underlying economy.
Okay, if the wealth effect is a mirage, then who's actually footing the bill for these low interest rate policies? Our sources point to a really surprising consequence.
Yeah, it's pretty shocking. They calculate a $400 billion per year wealth transfer from everyday Americans to large banks. $400 billion every year.
How does that work?
Well, the zero interest rate policy punishes savers. People playing it safe, putting money in savings accounts, CDs, they get basically nothing. And interestingly, it forces some people to save even more because they can't get any return. It's a kind of behavioral response not taught in textbooks or included in models used by the Fed. People reacting in ways the models just don't predict.
So it hurts savers, and it also pushes others towards riskier things.
Absolutely. If safe assets yield nothing, you're incentivized to chase higher returns in risky assets. And it enables all sorts of complex, murky financial deals. Things like asset swaps, collateral swaps.
Did you break those out? Were they?
They're basically complex ways banks exchange assets or guarantees, often off their main books. For example, a bank might pledge some low-rated stuff it owns to borrow super safe treasury notes. Then they use those treasuries as collateral for high-risk, high-yield derivative trades that don't even show up on their main balance sheet. It makes it really hard to see the true risk they're taking on.
So it creates hidden dangers in the system.
Exactly. Our sources call it an invisible web of counterparty risk. One bank's failure could cascade through the system. They warn it's setting us up for a replay of the panic of 2008 on a larger scale.
And the irony is, these U.S. policies aimed at helping the U.S. can actually mess things up for other countries, too.
Right. It's not happening in a vacuum. When the Fed tries to create inflation here, it can actually make deflation worse for trading partners, like Japan. This can lead to countries trying to devalue their currencies to compete, like when the Japanese yen plunged 33% against the dollar between September 2012 and May 2013. The sources say it just creates global confusion, not really effective policy. It ends up being a race to the bottom.
Okay, so this fragility, this interconnected risk,
Right.
our sources say it opens the door to something else entirely, financial warfare. This sounds like something out of a movie.
It does, but the argument is serious. The idea is that attacking a country's financial markets, destroying wealth that way, can be more effective than sinking enemy ships. It's warfare shifted from the battlefield to the balance sheet.
And there are actual strategists thinking about this.
Yes. The sources point to Andy Marshall, a longtime senior figure at the Pentagon. He was a key theorist behind the Revolution in Military Affairs, or RMA, basically, how technology changes warfare. Apparently, his writings were studied very closely, even translated by the Chinese military. This thinking influenced books like Unrestricted Warfare, written by two Chinese colonels back in 1999.
And that book wasn't just abstract theory, was it? It came out of a real event.
Exactly. It was written right after the 1997 Asian financial crisis. From the perspective of many in Asia, that crisis felt like a deliberate attack by the West. Hot money, pulling out quickly, questionable IMF advice. Our sources argue this experience directly pushed China to develop its own doctrine for financial warfare. It connects theory to, well, potential real-world strategy.
Speaking of real-world events,
Yeah.
the sources bring up 9/11 and market activity around that time. That's pretty chilling.
It is. They focus on unusual trading in options, particularly put options on American Airlines, which are basically bets that the stock price will fall. John Mulherin, who ran a big firm that made markets in American Airlines stock, knew that insider trading often leaves these kinds of telltale price signals.
And there was unusual trading before 9/11.
Yes. On September 10th, 2001, the day before the attacks, there was a huge spike in trading of these put options. 4,516 contracts traded. The sources suggest that even a small amount of terrorist insider trading could have kicked off a snowball effect. Other traders, seeing the unusual activity, jumped in piggyback trading, assuming someone knew something bad was coming, even if they didn't know what.
Wow. And this led to actual government projects trying to detect this stuff.
It did. Post 9/11, the CIA launched something called Project Prophesy. They brought in outside experts, people like Steve Levitt, the Freakonomics guy, hedge fund billionaires, plus CIA analysts like an options trader named Randy Taus. The author of one of our sources was actually part of the Skunkworks team, building a system to spot this kind of insider trading based on market signals.
A Skunkworks team. Did it actually work?
Apparently, yes. They share a really striking story. On August 7th, 2006, the system suddenly flashed red on American Airlines. There was no public news to explain it. Just 3 days later, August 10th, the news broke about the terrorist plot in London to blow up airplanes using liquid explosives. The sources say the attack planning seemed to be unfolding in exactly the time frame that our behavioral modeling had estimated. It's a stark example of trying to read these faint signals in the market noise.
So moving forward, how would a modern financial attack actually play out? What kind of tactics are we talking about?
The sources detail things like deliberately spreading fake news, rumors about a Fed chairman being kidnapped or a major bank failing or stock exchanges having technical problems. These stories would be designed to sound plausible, to mimic events that have actually happened, specifically to cause panic.
And our current market safeguards wouldn't stop that.
Not necessarily. Those safeguards are mostly built assuming traders are rational and trying to make money. They do not stop the financial warrior, whose goal isn't profit, but causing a collapse. They also talk about sleeper hedge funds. These could be set up years in advance, maybe acting like normal funds but secretly gathering intelligence. They'd be hidden behind layers of legal entities in tax haven countries, possibly involving corrupt lawyers or bankers. Very hard to trace.
And are there actual examples of countries using financial pressure like this? It's not just theory.
No, the sources give examples. They mention China Investment Corporation, the Sovereign Wealth Fund, buying a big stake in Blackstone back in 2007, potentially for insider access. They cite a senior Chinese official who apparently suggested attacking Japan's bond market in 2012. And they mention reports of China hacking the Reserve Bank of Australia in 2013. The sources frame these as part of a long-term effort to operate in stealth, infiltrate critical nodes, and acquire valuable corporate information.
But it's not just China. The U.S. has used financial weapons too, right?
Absolutely. The sources are clear it's a tool used by multiple players. They point to the U.S. actions against Iran in 2012, cutting it off from the global payment system SWIFT. That triggered a currency collapse, hyperinflation, and a bank run in Iran. Iran's response included dumping dollars and buying gold, and setting up oil for gold swap deals with countries like India and Turkey to bypass sanctions.
So countries are actively preparing for this stuff, running simulations.
Yes. Our sources mention financial war games being run by various groups, think tanks like the Federation of American Scientists, even the Swiss Army. The Swiss Army ran Operation Duplex Barbara in 2013, which simulated scenarios like defending banks from angry mobs trying to get their money back. It shows this is being taken seriously at high levels.
It all sounds incredibly fragile. You mentioned earlier the risk might not even be a deliberate attack, but just things falling apart by accident.
That's a major concern highlighted in the sources. They make a comparison to those old Cold War movies like Failsafe or Dr. Strangelove, where nuclear war starts by mistake. The warning is that today's financial markets are complex, tightly interconnected, and anything but fail-safe. They are increasingly failure-prone.
Like the flash crash.
Exactly. Things like the 2010 flash crash or the night capital trading glitch that nearly bankrupted the company in minutes. These aren't necessarily one-offs, the sources argue. They're emergent properties of complex systems, basically unexpected large-scale failures that can arise from the sheer complexity itself. We should be expected them.
And if such a collapse happened, deliberate or accidental, what does the day after look like according to these sources?
It's grim. No bombs dropped, no buildings destroyed, but potentially trillions in paper wealth vanishing overnight. Banks shutting their doors, maybe temporarily, maybe permanently, liquidity just drying up. Trust, the absolute bedrock of finance, would evaporate. And social unrest could easily follow. And the scary part, the Fed, after all the quantitative easing since 2008, might have no dry powder left. No more tools in the toolbox to fight the fire.
And realistic solutions aren't really on the table.
The sources suggest that things like breaking up the too big to fail banks or maybe even bringing back some role for gold, these are not under serious consideration by the key policymakers. So the vulnerability remains.
Okay, let's shift gears a bit and look at the big global players. China obviously is huge. Its growth has been incredible. GDP up 27 times in about 30 years, reaching $7.2 trillion by 2011. But our sources pour some cold water on the China miracle narrative.
They definitely do. They bring up Paul Krugman's old 1994 article, The Myth of Asia's Miracle. His point back then was that rapid growth based just on throwing more labor and capital at the problem eventually runs out of steam. You need productivity gains. Our sources argue China's recent high growth rates rely heavily on leverage, debt, and a dose of fraud. So the foundation might be much shakier than it looks.
A key part of that seems to be this massive focus on investment, right? Building things.
Yeah, it's way out of balance compared to other major economies. Investment makes up something like 50% of China's GDP. In the US, Germany, Japan, it's more like 15–20%. This leads to what the sources call wasted infrastructure spending. You get empty apartment buildings, huge ghost structures. They mention Nanjing having these enormous train stations with hardly any trains or passengers. It looks like growth, but it's not productive.
And fueling this, the shadow banking system. That sounds ominous.
It's a massive risk factor. This system, operating outside traditional banking regulations, is apparently larger than the entire German economy. And it's funding the same kinds of speculative, often wasteful projects, wasted infrastructure and property bubbles that caused the U.S. crisis in 2008. There's a huge risk of defaults and panic if the funding dries up.
So economic risks,
Right.
but also social ones.
Yes, the sources highlight enormous income inequality and cronyism. One expert they quote says social conditions in China closely resemble those in France just before the French Revolution. That obviously poses a huge threat to the continued rule of China's Communist Party.
So the challenge for China is massive. Can they shift their economy away from this investment-led model towards more consumer spending without crashing?
That's the multi-trillion-dollar question. Our sources argue it's almost impossible to do that rebalancing without a sharp decline in growth. the feared hard landing. And they state bluntly that neither the communists nor the world at large is prepared for that kind of slowdown. It would have huge global repercussions.
Okay, so while China faces these internal headwinds, Europe is presented somewhat differently in our sources.
Yeah.
Almost like a potential resurgence.
Yeah, it's an interesting contrast. They even trace the idea of European unity way back to Charlemagne in 800 AD, creating a unified silver standard. History matters, they imply, and they push back against what they call glib solutions for troubled Eurozone countries like Greece or Spain. Just leave the euro, devalue your currency.
Why is that glib?
Because, the sources I knew, Europeans understand that would basically be state-sanctioned theft from savers and small businesses whose savings are in euros. Devaluation wipes out value overnight. Instead, they point to internal adjustment primarily, lowering wages as something that is actually working, albeit painfully, in southern Europe. They mention Greek private sector salaries falling over 22% since early 2012.
Is there a concrete example of this working?
They give a pretty vivid one: the port of Piraeus in Greece. On the side, run by the Greek state company, union rules mean they use 9 workers per big crane. On the side, run by Costco, a Chinese shipping giant, they use just 4 people per crane. Much more efficient. It shows that internal reforms can boost competitiveness.
So the path forward for Europe is more integration.
That seems to be the message. More Europe, as Angela Merkel apparently called it. It means more uniformity on things like government budgets, bank rules, letting workers and capital move freely. Deeper integration is seen as the way to make the Eurozone truly stable and powerful.
And if Europe does integrate more deeply, what's its potential on the world stage? Could it really challenge the U.S. dollar?
Well, the EU is already the world's largest economic bloc by some measures. Our sources project it could become the world's economic superpower within the next decade or so, a huge integrated zone from Turkey potentially all the way to Greenland. And within that, Germany becomes the dominant economic force, largely through its influence over the European Central Bank and the euro.
Does Europe have the assets to back that up? We hear a lot about gold.
They certainly do. The combined gold reserves of the Eurozone countries are massive, over 10,000 tons. That's about 25% more than the official U.S. gold holdings. Our sources suggest this huge gold stockpile could give the euro credibility to potentially displace the dollar as the world's leading reserve currency by 2025, especially if faith in paper money continues to erode.
That brings us squarely to gold. Our sources talk about a gold renaissance. They don't see it just as a commodity like oil or copper.
No, they argue it's true money. Why? Because it has no maturity risk, it doesn't expire or default, and crucially, no counterparty risk. Its value doesn't depend on someone else's promise to pay. That makes it, in their view, the true risk-free asset, a very different perspective than you often hear.
And central banks are acting on this view, buying gold again.
There's been a major shift. For years, Western central banks were sellers. The UK's Gordon Brown famously sold a huge chunk of Britain's gold near the bottom of the market, losing billions. But now, countries like Russia and China are big buyers. China is apparently engaged in covert gold acquisition, aiming for maybe 4,000 tons, which would put them second only to the U.S.
Covert? How does that compare to Russia?
Russia's buying has been much more open. They increased their reserves by over 250% between 2004 and 2013, getting over 1,000 tons. Interestingly, the sources say Russia achieved strategic gold parity with the U.S. if you measure gold reserves relative to the size of the economy, GDP.
And why does this gold matter strategically?
The argument is that if the current international monetary system falters, if confidence in currencies like the dollar collapses, these large gold reserves could determine who would have the most influence in IMF or G20 negotiations about what comes next. It's about having leverage in a potential future reset.
Okay, so it's not just Europe potentially challenging the dollar. There are other forces at play, too.
Definitely. The sources point to the BRICS countries, Brazil, Russia, India, China, South Africa, working together more. Regional blocs like the Shanghai Cooperation Organization, SCO in Asia, and also the Gulf Cooperation Council, GCC, the oil-rich Arab states. They've talked about a single currency for years, if they ever launched it, and crucially, if they started pricing their oil exports in that currency instead of dollars.
That would be huge.
It would create immediate global demand for the new GCC currency, directly challenging the dollar's dominance in the crucial oil market. Plus, you have the rise of digital currencies like Bitcoin. Back in late 2013, it was already over $700 a coin, with millions circulating. And even things like electronic barter systems are growing. It all suggests communities around the world are seeking alternatives to the dollar.
This leads us naturally to the International Monetary Fund, the IMF. Our sources make a pretty bold claim that the IMF isn't just a lender, it's effectively become the central bank of the world. How do they back that up?
They look at what a central bank actually does. Three main things. It uses leverage, lending out more than its base capital. It makes loans, often as a lender of last resort. And crucially, it can create money. The sources argue the IMF has increasingly been doing all three, especially since the 2008 crisis and the subsequent European debt crisis bailouts.
Those bailouts were controversial, especially in the U.S., weren't they?
Very much so. There was significant political pushback, particularly from the Tea Party movement, against using U.S. taxpayer money via the IMF to bail out European countries. It even contributed to some prominent politicians like Barney Frank and Richard Lugar leaving Congress. It highlighted the political difficulty of the U.S. essentially funding the IMF to exert global influence.
But the IMF's really big power, according to these sources, is this money creation ability through something called special drawing rights, or SDRs. You said the name is confusing.
Yeah, the sources say the name SDR is designed more to confuse than to enlighten. Basically, SDRs are a kind of world money, an international reserve asset created by the IMF literally from thin air back in 1969. They were initially a response to a dollar crisis then, and worries about gold shortages. They're not tied directly to any single currency, but are based on a basket of major currencies.
And the IMF has a bigger vision for these SDRs.
The sources suggest the IMF's ultimate goal is a kind of one world, one bank, one currency system, with the SDR at the center. They think the next big global financial crisis, the next liquidity crunch, could be the catalyst for the IMF to push the SDR to displace the dollar as quickly as possible.
And China would support this.
The sources predict China would likely insist SDRs are used to replace the dollar in a crisis, not just prop it up. This would mean a significantly devalued dollar and force severe structural adjustments on the U.S. economy.
And underlying all this is the idea that the world's economic problems aren't just temporary dips, they're deeper, structural.
Exactly. The source says, quote, Min Zhu, who is the IMF's deputy managing director from China, he cut through the political noise, saying the problems are mostly structural and partly cyclical, but actually it's structural. What that means is you can't just fix things with more stimulus, more money printing. Structural problems need structural solutions, reforming labor markets, tax systems, regulations. But those solutions are often politically infeasible or economically dubious. Very hard to do.
So, wrapping this all up, what's the big picture for you, the listener? We've covered a lot today: the dollar's potential fragility, the eerie rise of financial warfare, China's tricky balancing act, Europe's potential comeback, the growing power of the IMF. It feels like the global financial system is at a real turning point.
It does. The sources really emphasize that the system is increasingly failure-prone. It's complex, interconnected, and could hit a critical state almost spontaneously, leading to a rapid collapse, much like some natural systems can.
And the current approach by central banks, just printing more money, isn't a real fix.
Our sources argue it's a pseudo-remedy, like putting a bandage on a deep wound. They compare it to Japan's decades of trying to stimulate its way out of stagnation. They suggest this path will continue until, inevitably, confidence is lost. A real solution, they contend, requires facing up to those difficult structural changes we talked about. But the political will just doesn't seem to be there.
So, the final thought for you to consider: how do these deep dives into the shifting global financial plates change your understanding of stability, of risk, of where wealth might reside in the future? It's not just economics for economists. These currents shape the world we all live in. Being truly well-informed, understanding these complex dynamics is probably the best compass you can have, navigating from this old world to whatever comes next.